Okay, this is lesson 2. We're going to go over the US 10-year bond yields, yeah? So remember we spoke about the DXY and the free channel, yeah? And the DXY dictates where other pairs will go, such as Euro USD and GBP USD, anything that's XXX USD. So just to recap, if the DXY goes up, anything that is cross to the dollar, so whatever the currency pair, if USD is at the end of it, they should go down, yeah? Because the dollar's strong, so it should bring down the pair of Euro USD. So we can see this move up. Yeah, let's look at this move up on the DXY, Euro USD. We get this move down, and on the DXY on this move down, we get this move up. So there's some sort of inverse correlation relationship between the DXY and anything that is crossed to the USD. Yeah. However, how would we know where the DXY is going, right? So the DXY isn't the end all be all. It's not the one we just looked at the DXY. There's something that's actually greater than the DXY that I'm not teaching in the free channel. Yeah. So how to know where the DXY is going? You look at this. This is the US 10-year bond yield. Yeah. So the greater the interest rate, the more valuable the currency is. So right now there's a bit of animosity around the USD because there's going to be an interest rate hike. So that's been USD bullish for a lot of people. So they want to increase interest rates. If you increase interest rates, the value of the dollar will increase. Yeah. The forex market's underlying mover is interest rates of the currencies. Yeah. Whenever there's a change in the interest rate of a currency, you will see a large, significant change. And now I know I said in the free channel and in my free chat, I don't care about news events. I don't care about the outcomes of news events, but you have to consider the overall macroeconomic standpoint of a country. What are they doing with the interest rates? What is the economic health of the economy? Yeah, are they doing well? Are they not doing well? Etc. Etc. That's the only thing you need to consider. Yeah, because that's going to dictate the higher time frame and the higher time frame dictates the lower time frames. Don't let anyone tell you otherwise, yeah? So, why would we look to the US 10-year bond yields? So, just make a note of this, yeah? Bonds, if the price of a bond goes up, the yield goes down. There's an inverse relationship between the bond's price and the bond's yield. If you study finance, you already know this, or study maybe economics, you'll know this as well, yeah? So, you see that this um, y-axis is a bit different. It's in percentages. This is the yield for the bond. It's in percentages, right? Because yield is basically interest earned on the bond. Yeah. Now, Omar, why are you talking about bonds and yields? What's all this shit? I want to learn forex. What's this? Where are interest rates derived from in the U.S. economy? Where did the Fed, yeah, the Federal Reserve, where did they dictate their interest rates from? Which then dictates what? The US dollar's value. Where does that all come from? We need to go from the beginning to understand the DXY. We need to go to the absolute beginning. It's derived from the bond yield. Yeah. If the bond yield goes down, interest rates overall will come down. The DXY will come down. Yeah? Now, if bond yields go up, interest rates go up, DXY goes up. So let's look at this graph on the daily, the US 10-year. Bullish move, DXY, bullish move. It's not 100% replicated. And this is the beauty of it. It's not 100% replicated. Yeah, so it's going up. US 10-year going up. Now, remember how I always get asked, yeah? I always get asked every single time, do your concepts work in Forex? Do they only work in crypto? Do they work in this? Do they work in that? Markets book the same way, yeah? We're just looking at electronic markets. Cover the currency pair or whatever it is, the asset class that you're trading. Just look at the price action. Nothing changes, yeah? Some are more clean than others because there's more liquidity in more markets than other markets. If a market has low liquidity, it will book different to a market that has high levels of liquidity, and that's a very big gem, by the way. That's a very, very big gem. If you look at markets with similar levels of liquidity, they will book in the same manner. So, if you're asking, does it? What's this here? An order block. Let's move it up to the wick. There was an order block on the US 10-year chart. Comes up, trades back into it, and it goes off. Yeah? Now, what do we see here? What does price want to go into on the daily, on the US 10-year? Yeah? There's this gap here that price looks like it wants to go into. So, how can we use the US 10-year to aid our DXY high time frame analysis? If we see that the US 10-year is heading towards some sort of objective, because remember what I said in lesson 1, yeah, algorithm wants to do what? It has two jobs. It wants to deliver liquidity whilst rebalancing imbalances or filling inefficiencies in the market. So we see this inefficiency in the market. So if we're saying that the US 10-year bond yield is going to come down into this area, where should we see the DXY go? We should see the DXY go lower as well. And what do we see? The DXY is going lower. Yeah, it's going lower, and there's an order block here. Yeah, and there's a tiny gap here. In here, there's a very, very tiny gap. But this order block is what I want to see the DXY come trade into. Now, from the US 10-year, we derived where we want to see the DXY go to. From using the DXY, where we know where the DXY is going to, what can we do with Euro USD? We know where Euro USD is going. Do you see how it all links? How there's all logic to the pair selection? Yeah? So now let's look at a time of consolidation, yeah? Let's look at consolidation in the 10-year. So okay, let's go from here. Yeah? So August to September, August, September. You see how it's the same on the DXY? It's range bound, yeah? And on the 10-year, it's range bound. The range bounds, obviously, this is more tight than the DXY. The DXY and the US 10-year, overall, they move in the same way, but it's not tit for tat, right? It doesn't move in the same velocity downwards and the same velocity upwards. But in a nutshell, if you can get the direction of the US 10-year, you have the direction of the DXY. Now, if you have the direction of the DXY, you get the direction of Euro USD and other pairs like GBP USD, etc. In a nutshell, when the US 10-year is going down, you are getting bullish on everything other than the dollar. Yeah. When the US 10-year is going up and is trending in the upwards direction, you are bearish on everything crossed to the dollar. So GBP USD, Euro USD, AUD USD, NZD USD, anything crossed to the dollar, you become bearish. Now, why is that? Why am I always looking at the high time frame? You lot want to know your daily bias. So, if you see the daily candle and you see what the daily candle's reaching into, day by day what the daily candle's reaching into, that gives your intraday bias, does it not? If you know that the daily candle is reaching into this imbalance here, would you not be bearish to get into there? So your intraday bias is then being bearish. This is why the high time frame trumps the low time frame. People get lost in the low time frame. Yeah, 4 hour, etc. I get that, but what you're doing, you're trading within the day. You're not trading within the 4 hour. You're not trading within the 1 hour. You're trading within the trading day. So you want to know how that daily candle forms, and if you can know how that daily candle will form, you have your bias every day for example, if we know that this candle is going to be a down close candle, yeah, so let's go on USD. If you know that this candle is going to be up close because we want to take out this high, we can see that it's made a swing low, yeah. Once this swing low has been made, we assume that price will come and make a swing high above here and take out this liquidity. So if we're bullish, all we need to do is wait for a retracement down in the day and become bullish. Yeah, there's a lot more to it. Don't think that that's, oh my god, he's gave me everything for trading. Listen, that is not enough, okay? We're going to go in way more detail. Yeah, but that is why the higher time frame is so important. And before you even get your bias from the Euro USD, you need to get your bias from the DXY, because that's going to give you, when they're in line together, that is the highest probability trade you can get for Euro USD. Now, to get in line with the DXY, you need to get in line with the US 10-year bond yields. Yeah, so just a recap of this one. As the US 10-year goes down, the DXY comes down. As it goes up, shown by this move up, the DXY makes a move up. Yeah, it's not exactly the same. Like you'll see the chart looks a bit different. So if we go from here to here, overall it's up, but it's not tit for tat the same again. Yeah. So what I want you to do is look at when there's been market structure change in the US 10-year. Yeah. So I'll show you, for example. So the 31st, the 31st of March. Yeah. The 31st of March or the start of April, you saw a decline down. Yeah. Surprise, surprise. 31st of March, we see the decline down. Yeah. Well, that's 20. That's 21. My bad. Let me go to 21 as well. So this is 2021. Yeah, 31st of March, and we see the decline down. Yeah. So when we see the market structure shift going from upwards, then we can, in the long run, get in line with the DXY. And you always want to be considering the long run of the currency. Don't think day to day. Yeah, because that's going to give you a headache. You want to know where currencies are going in the overall long run. And we're going to touch on it. Certain months, certain times of the year are more bullish for certain currencies. So we're going to touch on that in the mentorship, yeah? We're going to touch on that within the next, I think, 5 lessons. We'll touch on those things, yeah? But for now, I want you not to consider the 10-year bond yield and now use that in line with the DXY to help your analysis to get the biases for anything close to the dollar. Because this is going to give you a bias for the DXY. The DXY gives you a bias for pairs such as Euro USD and GBP USD. Yeah. Now, when the 10-year bond yield is consolidating, you know that the DXY is going to be consolidating. So look for the futures and find the cross pair in the futures. If you haven't seen that lesson already in the free Telegram, that's lesson 2 in the Telegram channel, I believe. Yeah. So when the DXY is consolidating, you want to look for a pair that isn't consolidating because that's going to offer you the greatest probability trades, right? So you have to look towards the futures and pair a strong currency and a weak currency. That's going to give you the most explosive moves to one side. Yeah. So that's it for lesson 2. This has been lesson 2, US 10-year bond yield. And what this does is it gives you the bigger narrative for the DXY because the value of the DXY is derived from the yield of the US 10-year bond yield. As the bond yield goes down, the value of the DXY goes down, vice versa. They have a positive relationship. So that's been lesson 2. Any questions, do you ask me in the Discord? Yeah. I hope this makes sense. I hope this is something new. Yeah. And don't think that this is boring, right? Because I know you're at the start of your journey and you just want to learn technicals. You will realize in a year's time that this is the important boring stuff. The boring stuff is important. You lot all want to know your bias. This is how you get your bias. Yeah? This is how you get your long-term bias. Once you got your long-term bias, it's easy from there. You just got to change it a bit day in, day out. It's easy, that stuff. but you need to know where this is going in the long run, yeah? So any questions, ask me in the Discord, and that's the end of the second video, yeah? Take care of yourselves, guys.